In the last 24 hours, the precious metals market has delivered some of the most chaotic price action we have seen all year, and I do not say that lightly. What happened overnight was not normal volatility. These were the kinds of moves that change portfolios, shift sentiment, and potentially alter the direction of the entire market. Gold crashed. Silver collapsed even harder. Then, in the middle of the night, everything reversed. And now, the market is trapped between two completely opposite stories. On one side, President Trump says military strikes have been postponed for 5 days and that talks with Iran have been productive. On the other side, Iran is reportedly denying that any real progress has happened. That is the setup. So in this video, I want to break down exactly what happened, why it happened, and what the next 5 days could mean for gold, silver, oil, the dollar, and global markets as a whole. This is Bridgeport Finance Channel, because right now, most of what you are hearing is incomplete. Gold fell overnight to $4,100 an ounce, a 4-month low. Just let that sink in for a second. This is the same metal that was trading near $5,595 only 2 months ago. That is a drop of nearly $1,500, or about 27%, in a very short period. Silver was hit even harder. Silver fell to $61.21 overnight, a 3.5-month low. At the end of January, silver was trading around $122. It hit $61 last night. That is a 50% collapse. Half its value gone in weeks. Then everything flipped. In the middle of the night, Trump posted on Truth Social that he had ordered the Pentagon to postpone military strikes against Iranian power plants and energy infrastructure for a 5-day period. He also said the United States and Iran had very good and productive conversations over the last 2 days, and the market reacted instantly. Crude oil dropped more than 10%. Gold reversed sharply off the $4,100 low and rallied roughly $270 to around $4,269. Silver bounced from $61.21 to roughly $67.63. Stocks rebounded, bonds rallied, risk came back fast. But here is where this becomes dangerous. Iran's news agency reportedly denied Trump's claim of progress. Iran is saying there has been no productive conversation. Iran is saying there is no deal. So now the market has two opposing signals at the exact same time. The President of the United States is signaling de-escalation. Iran is signaling that no real progress exists. And for traders, investors, and anyone holding precious metals, that creates a deeply unstable setup. Because over the next 5 days, the market is going to find out which version of reality is closer to the truth. Before I go deeper, let me say this clearly to everyone new here. I do not sell courses. I do not sell signals. I do not sell mentorships. I do not run paid groups. What I try to do on this channel is give you the full picture from both sides. The bearish case with real data, the bullish case with real data. I am not here to tell you gold is definitely going to the moon, and I am not here to tell you everything is crashing forever. My job is to show you the levels, the forces, and the risks so you can make smarter decisions. Now, let's connect the dots because this Trump announcement does not exist in isolation. There are at least 6 major forces hitting this market at the same time. The first is the 5-day postponement itself. This is important. The strikes were not canceled, they were paused. That is a huge difference. A cancellation means the threat is gone. A pause means the threat is still alive. Military assets are still in position. The crisis has not ended. The deadline has simply been extended. And if there is no agreement within that 5-day window, those strikes could still happen. So anyone trading this move as if the geopolitical risk is fully gone may be making a very dangerous assumption. This is not peace. This is a timeout. And Iran denying that productive talks are even happening makes that timeout even more fragile. Second, the physical damage on the ground has not stopped. According to the transcript, more than 40 energy assets across the Middle East have already been damaged since the conflict began. That includes refineries, pipelines, gas facilities, storage terminals, and production infrastructure. And that matters because damaged infrastructure does not magically heal because one post hits social media. Repairs take months, sometimes years. So even if direct escalation pauses for 5 days, The supply disruption that has already happened is still real. That matters for oil. And once oil matters, inflation matters. And once inflation matters, gold and silver start trading in a very different way. That brings me to the third force, Goldman Sachs. According to your transcript, Goldman raised its 2026 crude oil forecast. Brent was moved up to $85 a barrel from $77. The WTI was raised to $79 from $72. Why does that matter? Because Goldman's forecast is not based on a quick scare. It is based on a serious disruption scenario. The assumption in the transcript is that flows through the Strait of Hormuz could remain at just 5% of normal levels for 6 weeks, followed by only a gradual recovery. If that kind of disruption plays out, the supply shock would be massive, and that changes everything. Higher oil feeds inflation. Higher inflation changes rate expectations. Higher rate expectations push yields up, and higher yields create pressure on non-yielding assets like gold and silver. So even if the market gets a short-term relief bounce on de-escalation hopes, the deeper inflation shock may still be sitting underneath the surface. Now here is the fourth force, and in my view, this is one of the biggest. The US dollar. This is the part many precious metals investors do not want to talk about, but right now it may be the most important variable in the entire setup. A stronger dollar is a direct headwind for gold and silver. Why? Because gold is priced in dollars. When the dollar rises, gold becomes more expensive for buyers using other currencies. That naturally reduces demand. And the logic in your transcript is simple. The US economy is better insulated from an energy shock than many other major economies, especially because the US is a net energy exporter. So while other countries may be taking a bigger hit from higher import costs, the United States may actually look relatively stronger by comparison. And when money looks for safety and relative strength, it often flows into the dollar. That is bad news for metals. So now you have a market where geopolitical stress is rising, but instead of gold acting like a classic safe haven, the stronger dollar and higher yields are overpowering that narrative. And that leads directly into the fifth force. Gold and silver have not behaved like traditional safe havens during this conflict. That is one of the strongest arguments in your original transcript, and it is a key reason this story matters. In a normal crisis, you would expect gold and silver to benefit from fear. But according to your source, gold is down more than 18% since the conflict began, and silver is down more than 30%. Yes, both metals initially spiked. That part looked like classic safe haven behavior, but then they reversed hard. And that tells you the market is being driven by a different chain reaction. War leads to energy inflation. Energy inflation pushes up rate expectations. Higher rate expectations strengthen the dollar and yields. And a stronger dollar plus higher yields puts pressure on precious metals. That is the paradigm shift. Right now, metals are not trading primarily on fear. They are trading on macro pressure. That is a very different environment, and if you do not understand that shift, this market can punish you fast. The sixth force is physical demand, especially from India. Your transcript points out that India is one of the largest consumers of gold and silver in the world. If the broader conflict creates an acute energy strain and tighter consumer conditions there, that could reduce disposable income and weaken physical demand. That matters because physical demand has been one of the pillars supporting the metal story. So if that pillar starts to weaken at the same time the dollar stays strong and oil stays elevated, the bearish pressure can build quickly. Now let's move to the technical levels, because in a market this volatile, levels matter. For gold, the first support zone is around $4,300, below that $4,250, and below that the critical line is $4,100, which was the overnight low. That is the level bears need to break to trigger another leg down. On the upside, the first resistance zone is around $4,500, then roughly $4,537, and the bigger resistance area bulls need to reclaim is $4,650. So here is the battle line. Above $4,650, the tone of this market changes in a much more bullish direction. Below $4,100, the tone changes in the opposite direction. Between those levels, expect noise, chop, and emotional price swings. For silver, first support is around $65. Below that, the overnight low near 61.21. If silver loses that area, the next target becomes $60, and below that, the door opens toward the $50 zone. On the upside, first resistance is around $69.72, then the psychological $70 level. The major zone bulls need to reclaim is $80. And until silver can reclaim $80 on a closing basis, every sharp rally will still look vulnerable. Now pause for a second. This is where most people make their worst decisions. Big overnight moves, conflicting headlines, oil collapsing, gold bouncing, silver ripping higher in a matter of hours. That kind of tape pulls people into emotional trading. So the real question is not just what the market did. The real question is, did you have a plan before it happened? Because if you did not, this kind of environment will expose that immediately. Now let's look ahead. Over the next 5 days, there are really two main scenarios. The bearish case is that Iran is closer to the truth, there is no real progress, and this 5-day pause is simply a delay before another round of escalation. In that scenario, oil reverses higher again. Supply disruptions continue. Inflation pressure stays elevated. Central banks remain hawkish. The dollar stays strong. Yields stay firm. And if that happens, gold could break below $4,100 and target $4,000. Silver could lose $61 and start moving deeper into the $50 to $60 zone. In that version of events, this bounce becomes a trap. People buy the relief rally, only to get hit by another leg lower if the geopolitical situation worsens. Now, the bullish case is the opposite. The bullish case is that the 5-day pause is real. Private talks are actually happening behind the scenes, and the public denials are just political positioning. If that is true, then the market may have already seen a major emotional flush. Oil continues to cool down. Inflation expectations ease, rate cut expectations improve, the dollar loses strength, yields pull back, and if all of that happens together, the pressure-crushing metals starts to reverse. That is when today's rebound becomes more than a dead cat bounce. That is when gold holding $4,100 starts to look like major support. That is when silver's violent reversal from the lows starts to look like capitulation, where weak hands get flushed out right before a stronger turn. And if real de-escalation takes hold, then a short covering rally in gold and silver could be aggressive, because so much fear and liquidation has already happened. So what are the 3 biggest takeaways here? Number 1, the 5-day pause is now the most important variable in this entire market, not just for metals, for oil, stocks, bonds, currencies, and maybe even crypto. If that window ends without progress, the market may price in another escalation very quickly. If that window produces a genuine framework for de-escalation, metals could reverse much harder than many people expect. Number 2, today's reversal is important but not decisive. A sharp bounce matters. It tells you buyers are still there. But one bounce does not end a downtrend by itself. Gold needs to hold above key support and build a base. Silver needs to stabilize above support and stop breaking down on every rally attempt. Watch the daily closes. Daily closes tell you who actually won. Intraday moves only tell you who is fighting. And number 3, the dollar and oil now matter more than the old safe haven story. That is the big shift. If the dollar keeps rising, gold and silver can still struggle even in a dangerous geopolitical environment. If oil stays high and inflation pressure stays alive, metals may continue facing macro headwinds. That is why blindly buying metals just because the world looks unstable is not enough in this cycle. You have to understand how inflation, rates, yields, and currency flows are interacting. And right now, that macro chain is dominating. So where does that leave us? It leaves us in one of the most unresolved, unstable, and emotionally charged periods this market has seen in a long time. We have a US president saying talks are productive. We have Iran denying it. We have gold bouncing hard but still heavily damaged. We have silver rebounding, but from extremely weak levels. We have oil dropping on hope, while the broader supply story still looks dangerous. We have a strong dollar, fragile sentiment, and a 5-day countdown that could end in either real progress or a renewed wave of escalation. That means clarity matters more than conviction. If you are over-leveraged in either direction, this is not the time for ego. This is the time for risk control. If de-escalation proves real, there will still be time to position as the market confirms it. If it proves false, preserving capital now will matter a lot more than trying to be early. So stay disciplined. Watch the data, not just the headlines. Watch the levels, not just the emotion. And most importantly, have separate plans for both outcomes. Because right now, the only thing that is truly clear is this: the next 5 days matter more than the last 4 weeks. Gold bounced hard, but the bearish pressure is still there. Silver rebounded, but the technical damage is still severe. The dollar remains strong. Oil is still central to the story, and nothing is settled yet. So stay sharp, protect your capital, and do not let emotion make decisions your strategy did not approve. 5 days. That is the clock. If you found the breakdown in this video helpful, subscribe to Bridgeport Finance channel, like and share to people that might need this. Also turn on notification bell, and whatever breaks first will tell us a lot about where this market goes next. Thanks for watching, and see you next.